These 5 investments can allow you to profit during periods of high inflation. Have you ever noticed how you go to the supermarket and with the same amount of money as last year, you fill only half your cart? Well, that's inflation, that nasty phenomenon that erodes the purchasing power of our savings. But don't worry, there are strategies to protect yourself and even profit during periods of high inflation. In this video, I'll reveal the 5 anti-inflation assets you might not know about. Make sure to stay until the end, because the last 2 are the most underrated. Let's start. Number 1. Commodities. You know those essential resources found in nature like oil, natural gas, and wheat. Due to the high demand for basic goods, these tend to adjust their value as inflation rises. During economic downturns, consumers may cut back on non-essential spending like entertainment or luxury items, but they'll still need to buy essential goods. Think of wheat as the foundation of many families' diets, or fuel needed for people to get to work, or natural gas to heat our homes. This means that even as prices rise due to inflation, consumers will have no choice but to pay more. So how do we invest in commodities? There are several ways. You can invest directly in physical commodities or indirectly through financial instruments like futures, which track the exact performance of commodities. You can also invest in companies that are involved in commodities or in ETFs that replicate the overall market. Of course, like any investment, these make sense when included in a diversified portfolio. Nonetheless, given their strategic importance in the modern economy, they represent a safe investment in any market scenario. Number 2, gold and precious metals. Ever wondered why pirate chests were filled with gold? Gold has been the ultimate safe haven for centuries. It has numerous practical applications in modern industries, from electronics to aerospace and, of course, luxury. When currencies lose value due to inflation, gold tends to appreciate. This is because gold is a finite resource, and its supply is limited, while demand remains constant over time. Unlike currencies, which can be printed at will by governments, gold cannot be created out of thin air. But gold isn't the only precious metal that can help you protect against inflation. Silver, platinum, and palladium are also considered solid allies against inflation and offer another way to diversify your exposure to this sector. Investing in gold and precious metals is relatively simple. You can buy physical gold, like bars or coins, or invest in ETCs that track its performance, as well as in shares of companies related to the gold sector. Number 3, and this shouldn't surprise you, real estate. You've heard the saying, real estate is the best investment? Well, I'd definitely call it the anti-inflation investment par excellence. It's a primary need. No matter the cost, people will always need a place to sleep. How do you beat inflation with real estate? There are 2 main ways. Real estate tends to increase in value over time, especially if it's located in strategic and well-served areas. This means that by investing in a property today, you could sell it in the future at a price adjusted for inflation. Secondly, if you decide to rent out your property, you can benefit from a steady cash flow over time, and more importantly, you can adjust the rent to inflation with each lease renewal. There are several ways to invest in the real estate market. You can buy a property to rent out, participate in real estate development projects, or invest in REITs, real estate investment trusts, listed on the stock exchange. Investing in real estate requires a certain initial capital, which not everyone may have. However, even here, if you rely on external financing, such as a mortgage, the rising inflation will effectively dilute the debt, allowing you to pay less interest as inflation increases. A neat trick, isn't it? Finally, we come to the last, less commonly mentioned points when it comes to inflation. Number 4, Bitcoin, a modern option against inflation. Bitcoin, the pioneering cryptocurrency, is gaining ground as a hedge against inflation due to its decentralized nature and limited supply. Unlike traditional currencies, which can be printed indefinitely by central banks, Bitcoin's supply is capped at 21 million coins, making it inherently deflationary. This applies to Bitcoin as well as any decentralized cryptocurrency, meaning it is not subject to the devaluation dynamics of central banks. For some time now, people have been referring to digital gold and the consequent rush to acquire it. This makes it an interesting store of value, and this has been true over the past 2 decades. It's important to note that this point refers not only to Bitcoin as the main representative, but to any other digital asset that, by its nature, has a growing demand against a limited supply. The growing adoption of these types of assets, especially in the corporate sector, increases their long-term stability. As shown so far, most digital assets with the characteristics mentioned above have largely held their ground against inflation. So, digital gold, as long as you accept its volatility, is much higher than other safe havens. Investing in Bitcoin and cryptocurrencies requires the use of an exchange. Additionally, the decentralized nature of the asset allows for private custody, just as we would with gold. We can also invest in this type of asset indirectly through financial instruments like ETFs that hold Bitcoin, or as always, in stocks operating in the same sector. And finally, we arrive at the 5th and final asset, probably the most underrated. Number 5, bonds. Hold on, I know what you're thinking. Bonds are generally a conservative investment, and that's true, but this statement overlooks the bigger picture. In an inflationary economic environment, bonds have incredible potential. During periods of high inflation, central banks tend to raise interest rates. This, in turn, affects government bonds, which will have higher interest rates. In practice, the cost of money is higher for everyone, including governments borrowing from investors by issuing bonds. This is a great time to buy bonds with guaranteed returns because they are issued by governments at particularly high interest rates. For example, in an inflationary context, we could subscribe to a government bond at a particularly high interest rate and lock it in for the next 20 years. It's important to understand that in the modern economy, particularly high interest rates are not sustainable in the long term, as the entire modern economy is based on debt. This means it's in everyone's interest to reduce the cost of money as soon as possible so that they can refinance at lower interest rates. This gives rise to the bond seesaw phenomenon, where, despite new bonds having lower coupons, our previously purchased ones will guarantee a higher interest, making them very attractive for resale in the secondary market. Therefore, in a high inflation environment, it is incredibly strategic to rely on bonds to secure high interest rates guaranteed by the state, or to take advantage of the future lowering of interest rates to generate huge profits by reselling bonds at more competitive interest rates than the market will offer in the future. Profiting from any economic scenario is possible. Earlier, we mentioned stocks as a tool for investing in the various asset classes mentioned. However, without a deep understanding of how to analyze a stock, even in the most favorable economic scenario, your investments may not achieve the desired success. So, watch the following video where I explain in detail all the secrets to succeeding in stock investing.